What's happening? Y'all see it? Y'all know what time it is? Yeah, we live with it. You know what I'm saying? Let me go back over here. We live with it. You know what I'm saying? What they do, what they do, what they do, what they do. Let me put my headphones on. Y'all already know what time it is. Like I said, I'ma deliver. We're gonna deliver every time. Um, I got my boy coming on, Karrif. Y'all already know once we hit 100 people, we going live. Shouts out to everybody that's on this live, man. Y'all share this live, man. Share it to your baby mama, your wife, your husband, your significant other, whoever it is that y'all been talking to as a family. Y'all want to start thinking in the future. I got my boy on here. Oh, we already at 185 people. Y'all already know. Yeah. I got my boy on here, Karrif. He's finna explain to y'all DTI. Like I said earlier, he's gonna explain to y'all how to purchase a home. This is for families. You know what I'm saying? The families or people that want to get into real estate, however, whatever. But and also he gonna answer a few questions at the end. I just want this to be informative to y'all. Y'all already know, man. Y'all my people, man. We finna make this thing work. Real credit deal, sponsor this. So if you're ready, get your credit right. Text ready. 754-755-9774. No further ado. I'm finna bring my boy on. And he's gonna explain to y'all exactly how this goes. You know what I'm saying? And like I say, for y'all that don't know what DTI is, that is debt to income ratio. That's what that is. Hold on one second. We're gonna get him on, get him back on. Uh and then he gonna explain to y'all, you know, what's going on. I'm gonna get him on. But like I say, this is very informative, man. This is very informative, and he took the time out of his busy schedule to help me bring this information, y'all. So with no further ado, I'm about to bring him in now.
Hey, what's
Karrif,
going on? What's going
what's
on,
up, my
everybody? How
brother?
you doing? All right, so my name is Karrif Gardner. I'm with
Hey,
Gold Star Mortgage. Can you guys hear me okay? Are we good?
y'all make sure y'all let me know if y'all can hear him. We got
All right, yeah,
200
just to make sure that you guys can hear me. So I'm Karrif Gardner. I'm with Gold Star Mortgage. We're actually a direct lender down here in the South Florida area. All right, so we do all of the loan products that are available on the market. So we do conventional FHA, VA loans. We do FHA Streamline. I do refinances. I do cash out refis, home equity lines of credit. We even do we even have access to hard money as well, not
right.
through Gold Star, but through another company. I have access to hard money lending. So I really do work with realtors, real estate investors. I work with my self-employed, my individuals that want to be able to purchase residential real estate. Because that's the conversation that's happening right now. Everybody wants to
Right.
learn how to, make more money on their money versus leaving it in the bank. If you have the assets to do it, is how to leverage the money that you already have access to in the bank. And you know, the fact that this is
Right.
also being sponsored by a real credit deal, that's when you don't have access to those assets, having credit is what gives you leverage over the banks. And,
Right.
and that's something that people really got to understand is that taking care of your credit is when you don't have the cash, the what we call liquid. When you don't have cash that's liquid,
Right.
having great credit is almost as good as having good amount of cash, because that's your leverage over the bank. So what we see when we pull your credit high definitely determines what we're able to lend you, or if we're going to be able to lend you at all. So I do know that one of the topics that he wanted to speak about was debt to income ratio. All right, so debt to
Right.
income ratio is a very huge thing. So one of the first segments is gonna be credit, and then you deal with your debt to income ratio. So there's two things that a lender looks at
Mm-hmm.
when we're trying to qualify you for a loan, because your debt to how much income you make per month versus how much expenses you have every single month will determine the loan limit that we're willing
Right.
to give you. That's what determines the loan amount.
Right.
Is primarily your debt to income ratio, because a lender is not going to give you more mortgage than what you're going to be able to afford. All right, so
Right.
so conventional and FHA has caps. All right,
Right.
they have certain caps. So there's two ratios that they look at when trying to determine those two caps. They're going to look at how your maximum housing payment,
Right.
your maximum housing payment, and then they're going to look at your housing payment plus the total revolving debt that you currently have.
Right.
So when they talk about revolving debt, when we factor debt to income ratio for your mortgage, we're not talking about like your cell phone bill, FPL, internet and all that other stuff. We're talking about lines of credit. Okay, we're talking about your revolving lines of credit. So that dealing with credit cards, your installment debt, which is going to be your auto loans or any type of personal loans that you have. It's going to be your student loans. Okay, whether you're
Right.
paying them or not, if you currently have them in a deferment or forbearance, we still count that against you in regards to your debt to income ratio. And then also, if you currently have a mortgage already, because some people are, we have first time home buyers, and then we have people who are buying their second home or trying to buy an investment or trying to buy an investment property. You know what I mean? If you're
Right.
trying to buy an investment property and then you have property already, we have to factor in all those numbers into your debt to income ratio. All right.
Right.
So start off. What questions do you guys, or what do you guys have for me? Where do you want to start? Because this can go,
A lot of way. Let me
yeah.
ask you this. Let me ask you this, right?
Hmm.
Before we get into their questions, right? Kind of break down what they need as far as purchasing their first home as us. Let's say a family's coming, they just started a family, or they tired of paying rent, they want to get that first home. What is the main things they need to acquire that?
Okay. So the first things that we're gonna ask for last 2 years tax returns. We're gonna ask for last 2 years W-2s. We're gonna ask for 2 months bank statements to show the assets that you have for the down payment. Because when I'm trying to pre-qualify you for a particular loan amount, I need to know that you have the cash to close it.
Right.
I need to know that you have the cash to close it, because a lot of times people think that the down payment and closing cost, people, they have a wrong idea when they say down payment. People think it's just the down payment. It's down payment plus closing costs. All right.
Right.
So even if you're doing a 3.5% down program, you still have to factor in another 3.5 to almost 5% extra for the closing costs. Because we
Right.
live in Florida, taxes and insurance are they're held in escrow. Anytime you're putting less than 20% down, your monies is gonna be held into escrow. So
Hmm.
so what goes into escrow is gonna be factored into your closing costs. So
Right.
I can get into that towards the end, but those are the things that we kind of need. We need to know you got the assets. We need to know that you have the credit, and then
Hmm.
we need to know that you have 2 years of consistent income. So that's why we ask for 2 years tax returns. That's why we ask for
Hmm.
2 years tax returns, and then we ask for 2 years W-2s. All right. So when it comes to,
Let me
Mhm.
go ahead. Go ahead. I thought you was finished. Go ahead.
No, I mean, like I said, I can go in any direction when it comes to this. Okay, we can go in a direction
You
for the
rolling.
income, and
Right.
just the income
That's
has
what
its own segment.
that's why I wanted to ask you as far as credit score. What's a good credit score number that you guys kind of can say this is the sweet spot? Y'all kind of at least need to be here and up.
Okay. Well, prior to COVID, things changed since
Mhm.
COVID. Since COVID happened in March, lending has now tightened. Okay, they've
Okay.
now tightened how they lended, because the market was showing very similar traits to how the market was looking back in 2008. Prior
Mhm.
to the first crash. So in order to prevent the crash, what they do is they tighten lending. They tighten and up the requirements on lending to make sure that the loans that we're giving out are to people are well qualified buyers. Okay,
Right.
so you'll notice that all the banks raised their minimum. I think even Chase, America, Bank of America, Wells Fargo, they had raised their minimum requirements to 690, 700, 720 credit scores just to apply for an FHA loan. It
Wow.
went up. See,
Went
right
up.
now we're taking as low as a 640 credit score. So if you have an above a 640 credit score, you can qualify. Prior to
Right.
COVID, it was 620. It was 620 if
Right.
you wanted 3.5% down. If you had a
Mhm.
580, you just had to come with more money to the table.
To the
Okay, you had to
table.
come with
Okay.
10. You had to come with 10% down at 580. So until the market begins to regulate during these times. Now, granted, because of how the market is, interest rates are low. So because
Right.
interest rates are low, they've increased
Big.
the requirements in order to qualify.
Right.
But now it's
Oh,
still,
okay.
if you are able, now is really the best time to
Best
purchase.
time.
Best time to
Yeah.
purchase. In terms of like last year, same time last year, the average rate was like almost 5%, 4.85. That was good if you had great credit.
Right.
Now it's under 3%,
Right.
2.75. I closed a loan day before yesterday at 2.5%.
That's good.
So
That's good.
you know what I'm saying? Like
That's
it's
good.
available. Do you know what I mean? And the thing is, when interest rates are low, when interest rates are low, that means your mortgage monthly payment is lower on the same amount of
Right.
money. That allows us to lend you more money.
More
So
money.
that's why
Right.
now so that was a great time to buy, because the 3% that you're getting now can probably give you 250,000. But let's say
Hmm.
if it jumps up to 4.5 or 5% later on, because you're waiting, then
Right.
that 250,000, if you might have a bill, might go down to like 235, might go down to 230, 225, because now
Right.
the
Right.
mortgage payment is higher, and that puts the stress on your debt to income ratio, which is the main factor.
Right, right. And I hope y'all listening, man. From and yeah, COVID did, you know,
It
change a
changes.
couple of things up, man. But having good credit, like I say, like I tell y'all, man, good credit can get you a lot of things. You know what I'm saying? As
Mhm.
far as like you don't have to bust your ass to try to come up with this cash and do what the rich do, man. Like honestly, we can go to a couple of their questions, man.
Yeah, because credit is
Yeah,
leverage. That's your leverage over the bank what's on your credit.
what's
All
on your
right.
credit? Definitely. So, and I hope y'all got that too with the DTI. I hope y'all understand that also because, like I say, a lot of people hit me up about how to, once you get your credit right, how to acquire a home and all that good stuff. So, and a
Hmm.
lot of people, like I was telling you, a lot of people just have anxiety about
Hmm.
just the whole process, just because they don't know. But once you know, y'all see how easy it is. It's nothing. Okay, we got B Miles say, what is the difference between buying a home and rent to own?
And
Kind of
rent
self
to own.
yeah, it's
Well,
kind of
rent to
self
well,
Go
yeah.
ahead.
Well, rent to own is an agreement that you'll have with your landlord. So when you're dealing with a rent to own, let's say the house is valued at 200,000, and then you're on a lease, or you're living in the house for 2, 3, 4, 5 years, and then you're paying his rent. You're paying the rent and also paying down his mortgage. So after a period of time, based upon how much rent that you've paid, you can now negotiate a sales price to then go from, okay, now I'm going to buy this house from you. I'm getting into this agreement, living here for X amount of years, and then I'm going to change it over and try to finance it for the reduced balance based upon what you paid in rent over time. So
Right,
that's
right,
that's kind of that's when it kind of goes into different. Or you can just buy the house outright. So if the house is valued at 200,000 right now, you want to buy his house right now, you buy it right now. But then if you're
right,
not ready to buy it right, then if you're not ready to buy it right now, then you'll go into an agreement that will make sure that the landlord doesn't sell the house to anybody else. Because you got to understand, when you're living with the landlord can sell the house while you're still in it.
right.
You know what I mean? He
Sure,
just he just
yeah,
illegally he just needs to give you a 30 to 60-day notice, telling that he's gonna sell the house, and then you got to find something else.
right,
Give you back your security deposit, and that's it. But when you have a rent to own situation, his agreement is that he's not gonna sell to anybody while you're renting, while you're figuring out your situation to be able to
right.
afford the house.
Yeah, he won't be able to do it. Definitely y'all ask the questions, man, while I got him on here. I got him on here. Y'all ask the
Oh,
questions.
I see it. I see it.
You
Is
see
it
it?
better to pay cash or get a mortgage? I mean, that really all depends on you and your finances. You know what I mean? Like,
Yeah,
if you got the cash to buy the house, but then you're gonna dump out all of your liquid assets, and then you have nothing else, then that's not really the good thing. The idea is learning leverage. You know what I mean? Use the banks to work for you, and that's making money work for you. So if you have the assets to pay for a house cash, have the assets to
right,
pay for a house cash, then what you can probably do, then you can invest. That's when you'll do like a hard money loan, or you'll do like a traditional conventional loan, which those would get you the best interest rates when you're putting down more. If you have the ability to put down more than 20%, if you have the ability to put down more than 20%, then you're going to get the best interest rates. You're no longer going to be paying for mortgage insurance, and then you have access to a little bit more things. If you have the
right,
ability to put 30% down, then you can get into a realm where you can do, the bank will give you whatever you want. Like, there's less qualifications are required when you got 30% of whatever it is you want to borrow. You know what I mean? Like, especially if you want to buy, like,
Mm-hmm.
houses that are going under foreclosure, houses that have liens, or, those fix and flips houses, because some of those houses can't be financed. Sometimes I get people that's like,
Right.
oh yeah, I got a really good deal. This, this house is going under foreclosure. You can't finance that under traditional. Those are cash buys only. Those are cash buys
Right.
only. Well, when they say cash buy, hard money is considered cash. So hard money
Right.
is considered cash. So you could, if you have 30%, let's say it's 150,000, let's say it's $150,000 investment property, and you got 50 grand. Okay, cool. We'll lend you the rest to buy that $150,000 property. And then let's say that $150,000 property is worth 200,000. Now it's a short term. Hard money loans are short term loans. So
Right. Quick.
hard money is meant to, is if you're buying you don't want to buy your forever home on a hard money loan. You're
No.
you're buying something to get it now.
Quick.
You're,
Yeah.
you're buying something to get it now, and then after 12 months you'll then flip it into a conventional loan. You'll refinance at that point, or you've sold it before, what I mean, before the term ends.
Right. You see, okay. She said, can you get a loan for a house, even if you're already paying on another type of loan? I don't know
I
if
mean, I get what you're saying. Yes, you can. Of course you can.
okay.
It just all depends. That's where it comes down to debt to income ratio. It comes down to debt
Right.
to income ratio. Can you afford two mortgages? You know what I
Right.
mean? Can you afford two mortgages? Or if your first loan is an FHA loan, that means the second loan has to be a conventional loan.
Right.
You can't get two FHA loans in the same exact area.
Definitely. Definitely. And you see Stephen Brown, see what he's saying on here?
Uh-huh.
On a $200,000 home, how much should you put down for a down payment, and how much should you have for closing costs? I guess that all varies though, right?
It really all varies. You know what I mean?
Yeah.
It really all varies. If you want to do the minimum down payment is gonna be 3.5% on an FHA loan, or 3% on conventional.
Hmm.
I would determining which loan for you depends on what your credit is. Like, if your credit is not above a 680, I would never put a client into a conventional. I will put them into an FHA loan, because FHA
Hmm.
is more favorable towards the lower credit scores. Okay,
Right.
conventional then becomes more favorable when you start going past 680 to 700 credit scores, where it becomes a more favorable option for you. But when it comes to down payment on a $200,000 house, like, if you want to be realistic, think about like 8%. I'll
Hmm.
tell you like that, 8%. So that's what come up to about what, 16,000. You know what I mean? And down payment plus closing costs factored into that whole thing. Now, closing costs is something that can be negotiated. That's
Hmm.
negotiated between your realtor and your seller. But
Right.
so you can get closing costs factored into your deal, but then it all depends on your negotiations between the house that you're buying. If there's a bunch of different offers on the house, you know what I mean. If you're the only offer on the house, then you can then absolutely go for it. Yeah, I want a 3% seller's concession, which is 3% closing cost credit. You know what I mean. That would end up reducing your cash to close,
Mhm.
with no problems. But a lot of
Right.
times when when I try to tell my clients to be, I try to be very realistic with my clients, factor in about 8%, only because we live in Florida, and when closing costs is dealing with, when you're putting down less
Yeah.
than 20%, is going to be dealing with your settlement fees, is going to be dealing with any points that you have to pay to get a lower interest rate. It's going to deal with processing fees. It's also going to deal with collecting for taxes and homeowners insurance, because you have
Yeah.
to escrow. Okay,
Right.
anytime you put down less than 20%, you got to escrow. So we have to collect for like a year's worth of taxes and a year's worth of insurance up front, and that's factored into closing. And then what an escrow account is. So when it comes into your mortgage payment, I'm gonna get into the mortgage payment. So when it comes into the
Mhm.
mortgage payment, when you put down less than 20%, what's factored into your mortgage payment is going to be principal, interest, taxes, homeowners
Mhm.
insurance taxes. Homeowners insurance, real estate taxes,
Mhm.
mortgage insurance, and then if your place has an HOA.
Yeah.
Okay, if your
HOA.
and if your place has an HOA.
Right.
So a lot of times when people start doing research they start looking for houses on Zillow and so on and so forth. They're not looking at the fact that Zillow is automatically factoring in, they're putting in 20%, and then they're not factoring in mortgage insurance into the payment. So sometimes people will get into like a buyer shock when they come in. It's like, oh, well, this mortgage payment is a lot higher than what I thought it was going to be. Yeah, that's because when you're putting less than 20% down, all these other things are going to be factored into your mortgage. And then your tax, what's held in escrow is your mortgage insurance, is your real estate taxes, and your homeowner's insurance. And how that escrow account works is that every single month you make your mortgage payment, they're taking a certain amount of money and putting it into a separate account for you. And then at that time when the bill is due, whenever your insurance bill is due or when your property tax bill is due, that's when the escrow agent goes in and pays that bill for you. So that's how escrow works.
Right.
Mm-hmm.
Okay, we'll take a couple of more, man. I know I got you on. Hey, that's some good information, man. Hope y'all
and you guys, let me know if I'm talking fast. Like I do this every single day, so I understand when people don't understand the jargon. You know, people don't understand the jargon, don't understand the lingo, but yet they want to understand and they want to be able to put themselves in better position. Me as a loan officer, I'm probably one of the only. I literally walk all my clients through the steps from start to finish, and to make sure that they understand it. Because when I'm talking to a client, we're not going to do this the first time. It's not the first time that we're going to do this. We're probably going to do this again in the future. We're probably going to do this again. We're probably going to be buying another house in 3 years. I'm all about building relationships and putting my clients in a better position to win. And if they want to acquire assets over time, if that's the game plan, then we'll start talking about that from the beginning, and then we'll go through the steps 1, 2, 3, all the way till you get the keys.
Get it? Yeah. Yolanda says, should you close retail accounts before purchasing a home?
Should you close retail account? Would you close retail accounts? You mean like credit cards?
Yeah, I kind of think that's what it is.
No, I do not close any credit card. Don't close your credit cards.
Yeah.
Okay. You want to because when you close your credit cards, what that does, it cuts off that loan that not only that history, but then also that available credit. Lenders like to see that you have access to available credit. The idea is to have as much access to available credit as possible. It doesn't mean you have to use it, but having access to much available credit is a great thing. And having multiple trade lines of credit is a great thing. So
that's what it said. Trade line. That's
trade lines. Yeah. So you got the sweet spot. So that's the thing. And when people talk about like especially when we go into like credit and stuff like that, the first thing that hurts people a lot is one, your payment history, because your payment history is 35% of your entire credit score. But a lot of times people really don't understand how that's calculated, and then they really mess up. So if you look at Credit Karma would say 100 to 99% is an A rating. And then if you have a 98, that's a B rating. If you have a 97, that's a C, and anything under 97 is a D and an F. Right? So, and this is when I say having multiple trade lines is beneficial towards your credit. But the thing is that we were taught, like in our community, and I'm going to say our community because like I know growing up, I come from a Caribbean background, Jamaican. All right, they run away from credit. They say, "Oh, don't get a credit card, don't do this, don't do that." Yeah, I mean, which is the exact opposite. That's not where you're supposed to. You want to get a credit card as soon as you're available to get a credit card, because by the time you're ready to purchase, like by the time you're realistically ready to purchase, or a child or an individual is ready to purchase by 25, 26, 27, they would already have 8-9 years worth of credit history. But if you tell somebody to not get a credit card at 18, 19 years old, and then they're now getting a credit card at 23, 24, 25, we're not going to lend you. I'm not going to give you $250,000 to buy a house. You don't have enough credit history. You don't have enough credit history. And then when it comes to multiple trade lines, when it comes to having multiple trade lines, one thing that people got to understand, that whole payment history factor, that 99%, 98%, 97% that you see on Credit Karma, if you only have one credit card and you make one credit card payment every single month for 1 year, that's 12 payments. If you miss one payment out of that, I'm gonna do this calculation. So 11 divided by 12, that's 91%.
Right.
Okay. Remember what Credit Karma says? If you're a 97%, you're an F. Okay. So if you have only have one credit card and you made 12 payments and you missed just one payment, you're at 91%. It will take you so long to get back up to the 97 range if you're only dealing with one card.
One card.
Now
Yeah.
let's say you have 3 credit cards, right? So you have 3 credit cards. That means you're making let's say it's 3 minimum monthly payments a month. You're making minimum monthly payments a month. 35 divided by 36. That's 97%. So that's having 3 credit cards, right? That's having 3 credit cards making consistent payments for 12 months.
Right.
Now you have 36 payments, and then if you miss one, at least you're,
Still
you
in
know,
the
you
ballpark.
fall back a little bit, but you're kind of still in the game,
Right.
where
Right.
it may take you 6, 7, 8 months to get back into the 98, 99% category. You know what I mean? And when you look at Credit Karma and it says how many accounts you're supposed to have, they say an A rating is like 8 plus.
Right.
You know, it's like having 8 different lines of credit. Now, it doesn't mean 8 credit cards. It could be lines of credit. Could be, it could be it could be 1 credit cards, 2. It could be personal loans. It could be your
Right.
auto loan. It could be having it could be a mortgage, right? And it could be a student
Gotta be
loan. Each
both.
one of those are different lines.
Yeah.
Of credit. All right.
Right.
So that's different lines of credit. So that's just one tip. If you're trying to get your credit back on track, you know, having access to multiple lines of credit over time, that helps it, because fixing your credit can take some time. It can take a little time if you don't understand it.
And we teach them. We teach them that. You know what I'm saying? This is some of the a lot of the information we give out about credit. No one gives. Like I've had other companies like contact us and was like, "Yo, why y'all putting out that information?" They don't even want us to put the information out. But like at the end of the day, it's like, you know, you keep your face cool, like you say, man. You do good business. You keep your face clean. You sleep good at night. We giving out information that these people don't want you to have. You know what I'm saying? So, man, y'all take advantage of this, man. This is not something you're gonna just find on anywhere when it comes to fixing your credit or how you gonna go in and purchase a home, what you need to know and what you don't need to know. Like, you know how it go. Like you say, our people. You know what I'm saying? We understand. So
that's the thing. It's just that we're not having that conversation about credit early. I feel that credit and taxes is something that should be taught in high school, at least your senior year in high school or your freshman year in college. Is how to manage your credit at that age, and how to pay your taxes at that age. Because by the time they graduate from, if they do a 4-year or a 6-year program, they'll be ready to rock and roll, ready to buy a house, and won't need a cosigner. You know, and won't need a cosigner. That's the main thing. That's, I said, your credit history, what you are able to build. That's your leverage over the banks when you don't have it in the bank. You know what I mean? When you don't have it in the bank. So that's definitely that's the main thing.
That's the main thing, man. We're gonna B Miles said, how long before a house gains equity?
I mean, that depends on the market. You know what I mean? That depends on your market. That goes by your area. So that's really, we can't really say that. You know what I mean? It's hard to really determine when a house is going to build equity or not. I mean, you can, if you have a really good realtor, the realtor will determine if the house already has equity, because the equity when you purchase the home, you'll find out if you have equity in the home based upon what comes up on the appraisal. Okay, what comes up on the appraisal, because the appraisal is going to be determined based upon recent sales in the area. You know what I mean? So that's what determines the value of the house that you're looking at, or the value of the house that you're purchasing, is all the recent sales in the area. So in order to build equity, if the recent sales in your area start going up over time, then the property value of your home that you're in then goes up, because we're looking at all the recent sales. We're looking at all the recent sales, the square footage, how many houses in it, and then they do the plus and minuses from there.
Right.
So that's it when it comes to equity. Okay.
Okay. All right, we're gonna take another. This is good information, man. I'm telling you, man. I hope y'all paying attention, man, because this is good information. Some of this stuff I even learning myself, especially on the real estate side. You know, from that back office stuff. But definitely, man, we're gonna have you put your information out there too for those who want to directly contact you. You know what I'm saying?
Absolutely. I really only like I said, this conversation can go into so many places, because like buying a house is not as simple as just Like even having these, getting the information and then learning and then knowing what questions to ask when we have a real appointment where we can really go through, the details. You know what I mean?
Right.
So, because like even going back into the whole debt to income ratio thing, there's a whole other segment, in regards to
Right.
that too. Because like I was saying, there's two different debt to income ratios that we look at. There's your
Right.
housing payment, and then there's the total debt to income ratio plus the housing payment. And then trying to
Right.
get my people to avoid putting items in collections, because
Right.
if you got items in collections, I just want to let you know,
Right.
if you're not paying it, that don't mean when we pull it, we don't see it. And then when we
Right.
see it, I have to hit you with a payment that's going to work against your debt to income ratio. You know what I mean?
Right.
So same thing, just like your student loans. If you have your student loans and it's in forbearance, it's still debt. It's still debt. So any debt that we find on your credit, even though if you're not making a payment for it, we have to calculate a payment for it that's going to work against you.
Okay. Okay. Okay.
Okay. So that's the little things that lenders would see that you guys probably wouldn't know. All right. The best thing that you'd want your mortgage payment and your
Mhm.
current debts to be under 50% of your total income right
Right.
now. That's the best thing for conventional. FHA will allow you to have a little bit higher debt to income ratio, but
Mhm.
conventional, especially if my buyer are also looking for down payment assistance, they want less than 45% debt to income ratio. So you got to think
Right.
about how much mortgage you can afford versus, and plus, which is going to include what your car payment is going to include all your other
All this
installment
stuff.
debt. So you add all those totals up, you add
Uh-huh.
all those totals up, and then you divide that by your income, and that would tell you what your debt to income ratio is now, and then factor in what mortgage payment you think you can afford, and factor that in, and that will give you your total.
Right. Okay. We got
Okay.
one more question. We're gonna answer this last question, and we're gonna have you put out your information for those who want more
Okay.
information. Because this is
Say.
informative.
Mm-hmm.
What'd she
Okay,
say? She
so
said
if you got a 600 credit score, how much should you put down for? Well, the first thing that you'd want to do now is to work on your credit. Is to work on it. Remember, you want to be above 640. With everything that's going on right now, if you and I tell my buyers too, like if your credit, because we would work on credit in the process when you're purchasing a home. Like if you're trying to purchase a home within 30 to 60 days, that's something that I have to do an analysis on your credit, and I would say, okay, cool. Instead of getting the house right now, you need to take
right.
the assets that you have right now,
Mhm.
and you need to pay some of these items that's in collections, this,
Mhm.
that, so on and so forth. And when that boosts, and then we'll run a simulator, and once that boosts your credit score above 640, then we go in, and then we start to do the purchase on the house.
Right.
So, because the
That's
idea
dope.
is that if you want to put 3.5% down, you need to be at a 640. I'm gonna tell you that.
Right.
You
Right.
need to be at
Especially with the
640.
pandemic.
If you want to put minimum down, you want to be at a 640 credit score. And then
Definitely.
how much should you put down? How much you should put down depends on how much money we're able to give you. That starts from doing the mortgage pre-qualification process. So that's why if you want, you guys can give me a call at any time. I am available. This is what I do every single day.
Right.
So you guys can give me a call. We can have a detailed conversation in regards to what your current financial situation is. And then I'll
Right.
be able to give you a proper game plan on how, if you're not in the position to buy right now, I can put you in a position to buy by tax season. Because
Right.
not only do I do mortgages, but I also done taxes. I actually was doing taxes before I actually started in mortgage, and actually gave me an advantage in the mortgage field because I know exactly what the underwriters are looking for in the tax returns.
Right.
That determines whether this is going to be a pass or approval. So,
Right.
not only do I do taxes for my individuals, but I do it for my self-employed, my entrepreneurs, my partnerships, my corporations. I do them all, and I do them all. Even real estate investors. A lot of times, that's a very big, when you own different types of real estate. When you own rental property, there are so
Right.
many filters in the tax code that's through real estate that you can write off money in real estate. If you have rental property and you're
Uh-huh.
self-employed, there's certain expenses that you can write off
Right.
on your taxes. And then as a loan officer that understands this information, I can add some of those expenses back into your income to help increase your loan amount that you would normally qualify for. So just having that understanding of the tax returns gives you that advantage. So like I said, if you guys need that analysis, if you guys need that game plan, I'm available for you guys.
And that's some good information, man. Like I want y'all to understand this man. this is why I like to work with people like this, because as we know, every business you get in, there's people trying to jug and and jip you, and as you see, this ain't the case. Like
Mm-hmm.
literally gonna be straight up and down with you. You get what I'm
Mm-hmm.
saying? People with a conscience. You know what I'm saying? It's not just about a dollar or whatever the case. But I definitely want to. I'm gonna put your flyer up so that y'all can screenshot it. Y'all can come back, see it, start the video, start the live, whatever later.
Mm-hmm.
Get all
You
his
guys,
information.
yeah, my Instagram. If you want to follow me on Instagram, it's a very good contact. I'm always on there. My Instagram is kbg_inc. So kbg_inc. You can also follow my tax office, which is KBG Tax Service, on Instagram, and I'm also available on Facebook. Literally, if you just type in my name on Google, I'm all over there. We have reviews all over. When it comes to taxes, I service clients all over the country. I do all states. And I'm licensed for the entire state of Florida. So it doesn't matter where you're trying to purchase in the state of Florida, whether it could be Jacksonville, Miami, it could be Fort Myers, Tallahassee, it doesn't matter. I can get it done for you and partner you up with a realtor that will get it done for you.
Definitely. And like I say, man, I'm gonna drop the flyer on here, and then y'all can go back, check it out. All his information is gonna be on here. And like I say, man, take advantage of this, because you got a lot of people out there that will not give you this information. I'm telling y'all, I don't do this to waste my time. I don't do this to I get my blessings how I get them. But for people to see me in the streets and people to see me or hit me on the email or whatever and be like, man, appreciate you, man. You helped us. I'm cool with that. You get what I'm saying? I'm cool with that. So this man came on, you know what I'm saying? This is information right here. He came in, gave us great information, gave everybody great information on what's going on. And if you want more information from him, let me get this out the way. And then people can see for themselves, man. Like y'all can see it for yourself what's going on.
Instagram, KBG_inc. Go ahead and give me a follow. I'll see you. If you have any questions, just DM. You can DM me. We can do everything from there. It's no problem. I do the video calls and all from there. So
Right.
it's yeah. So because we can do appointments anywhere around the world based upon one thing I can tell you that COVID has taught everybody how to adapt and how to still get these still how to get things done. Even during these times, people were purchasing real estate and almost virtually seeing the home at first. They were virtually seeing the home at first, and we're doing closings from their home before versus having to go to the title office now. So everything has pretty much changed. We can pretty much get this done however you guys want to. Okay. So like I said again, Karrif Gardner, you guys, anything you guys need, just let me know.
Man, I appreciate you, my brother. Thank you,
no
man.
problem. No problem, man. This was cool. All right. So just let me know if you need anything, and then we'll get it done. All right.
Okay. Thank you.
All right.
All right. There y'all have it. You know what I'm saying? Like I said, man, we was gonna drop that today for everybody that's on here. Please make sure y'all share this live, and hopefully y'all got some information on how to go in and acquire your first time buying a home. And I know he was talking a little fast, but like he say, if you need any information, just hit him up. You get what I'm saying? His information is on here, and hit him up directly. You get what I'm saying? So I just want to appreciate everybody on the live. Make sure y'all go to Real Credit Deal, man. Go ahead, text ready to the number 754-755-9774. Get your credit right. Don't let these people fool you. You got it, like he said, you got people who don't know about credit, who don't know about debt. Listen, use their money, man. Do what they do. Once you learn how it goes, do what they do, you'll be fine. You'll be good, man. These people do this all the time. And it's other information that we're gonna be dropping on y'all also. So this live was sponsored by Real Credit Deal. And like I say, man, y'all know I'm gonna keep my faith gated. Y'all my people, you know what I mean? Like on everything. So with that being said, man, hope y'all have a blessed rest of y'all week. You know what I mean? And check out the podcast tomorrow. The Papa Duck podcast going down 8:30 tomorrow with Please Believe It Steve. Y'all already know what it is. And like I tell y'all, listen, man, get your credit right. With no credit, you can forget it. I'm out of here.